On the 16th of September, 2008, a fund manager in New York had to make a phone call that almost nobody in American finance had ever had to make. He had to tell his investors that a dollar they had given him was now worth 97 cents. That does not sound like a catastrophe, 3 cents. On a bad day, the stock market moves further than that before lunch. But this was not the stock market. This was a money market fund, the place where American companies and pension schemes and ordinary savers parked cash they were absolutely certain they would get back. The entire product rested on one promise: a dollar in, a dollar out, always. It was treated as cash, accounted for as cash, and used as cash. In 37 years, that promise had been broken exactly once, by a tiny fund almost nobody had heard of. Now it had been broken by the Reserve Primary Fund, $62 billion, one of the oldest and largest in the country. And within days, the machine that moves money around the American economy, not the stock market, the actual plumbing, stopped working. This is not the story of the housing bubble, though we will need it. It is not the story of Lehman Brothers, though that happens on the way. It is the story of the specific week in which the financial system of the largest economy on Earth came closer to simply ceasing to function than at any point since the 1930s. And the strange, technical, almost invisible mechanism that nearly did it. Because the crash everybody remembers is the one on television. Traders with their heads in their hands, a bank staff carrying cardboard boxes out of a building. The one that actually mattered happened in a market most people have never heard of, over about 72 hours. And it was measured not in share prices, but in whether companies could pay their staff at the end of the month. Let us build the machine first, because you cannot understand how it stopped until you see how it ran. Start with a mortgage, an ordinary one. A family buys a house, borrows money from a bank, agrees to pay it back over 30 years. For most of American banking history, that was the end of the story. The bank kept the loan. It sat on the bank's books for 3 decades, and the bank collected the payments, and the bank carried the risk. If the family stopped paying, that was the bank's problem, which meant the bank cared enormously about whether the family could pay. That single fact, the lender keeps the risk, was the discipline that held the whole system together. Nobody had to enforce it, it enforced itself. Then came securitization, and it dissolved that discipline entirely. The idea itself is not sinister, and it is worth being fair about it. Take 1,000 mortgages, pool them together, sell shares in the pool to investors. The investors get the mortgage payments as income. The bank gets its money back immediately and can lend again. The theory is genuine diversification. One family defaulting barely dents a pool of 1,000. Spread the risk across the whole country and no single local downturn can hurt you, because Florida and Ohio and California do not all fall at once. Hold on to that last assumption. It is the load-bearing wall of the entire structure, and it is the one that fails. Then the pools were sliced. This is the part that matters. Rather than selling equal shares, the pool was divided into tranches, layers, stacked by who gets paid first. The top layer gets the first mortgage payments that come in, so it is safest, so it pays the least interest. The bottom layer gets whatever is left after everyone else has been paid, so it absorbs the first losses, so it pays the most. And here is the alchemy. Because the top layer only fails after the layers beneath it are wiped out, the rating agencies gave that top tranche a AAA rating. The same rating as United States Treasury debt. Pause on that. You could take a pool of mortgages lent to borrowers with poor credit histories, apply this structure, and manufacture a security rated as safe as the debt of the United States government. By the middle of the 2000s, that machine was running at extraordinary scale. Subprime lending, loans to borrowers with weak credit, had gone from a small niche to roughly a fifth of all mortgage originations at the peak. And the demand was not coming from borrowers, it was coming from the other end. This is the detail people get backwards. The story is usually told as reckless Americans borrowing too much, but the pressure ran the other way. Investors worldwide wanted AAA paper that paid better than treasuries, and there were not enough good mortgages to satisfy them. So the machine needed more mortgages, any mortgages. And the industry duly produced them. Loans with no documentation of income, loans with no deposit. Teaser rates that started low and reset sharply after 2 years. Which mattered enormously, because the whole model assumed the borrower would refinance before the reset, and refinancing only works if the house has gone up in value. And it is worth being precise about how that happened at ground level, because it is not abstract. It comes down to how one person got paid. In the old arrangement, the bank that lent the money kept the loan. Its interest and the borrower's interest were, crudely, aligned. The bank made money if the borrower kept paying, and lost money if they did not. In the new arrangement, the loan was sold within weeks. And the person who arranged it, a mortgage broker, was typically paid a commission on completion. Read that carefully, paid when the loan closed, not when it was repaid. So the broker's income depended on volume, and the consequences of a bad loan landed somewhere else entirely, with whoever bought the security at the far end of a chain that might run through 4 or 5 institutions. Now apply that incentive to a borrower who cannot really afford the house. Under the old system, the lender's answer was no, because the lender would be the one absorbing the default. Under the new one, saying no simply meant no commission, and the risk of saying yes belonged to a stranger. This has a name in the industry: originate to distribute. And the effect compounds at every link. The broker is paid on volume. The lender is paid to package and sell. The bank arranging the security is paid a fee on the deal. The rating agency is paid by the arranger. Every single participant is compensated for completing the transaction, and not one of them holds the loan long enough to find out whether it was any good. That is the whole mechanism in a sentence. The system removed the one party who had a reason to check, and replaced them with a chain of parties who were each paid to keep it moving. It is worth saying plainly that this required no villainy. A broker approving a marginal loan is doing what the compensation structure asks, so is everybody downstream. There is no point in the chain where a single person has both the information and the incentive to stop, which is precisely why it ran for years without stopping. Now add the third layer, which is where it stops being a housing problem and becomes a systemic one. The lowest, riskiest tranches were hard to sell. So they were pooled together with other lowest tranches into a new security, a collateralized debt obligation, a CDO. And that new pool was itself sliced into tranches. And the top slice of the pool of worse slices was, once again, rated AAA. Then people built CDOs out of CDOs. Then, because there were not enough actual mortgages to feed even that, they built synthetic CDOs. Securities that contained no mortgages whatsoever, but merely referenced them, allowing an unlimited number of bets to be placed on the same underlying loans. A single struggling mortgage in Nevada could sit beneath many multiples of its own value in derivative exposure. And the whole edifice rested on the ratings. The ratings were what allowed pension funds and insurers and foreign central banks to buy this material at all, because their rules required investment-grade assets. So it is worth asking who was producing those ratings and how. The rating agencies were paid by the banks whose securities they rated. The bank arranging the deal chose which agency to hire and paid the fee, and could take the business elsewhere if the rating came back lower than it wanted. That is not a conspiracy, it is simply an incentive. Applied continuously to thousands of deals over several years, and incentives applied continuously do their work, whether or not anyone intends them to. The models the agencies used also relied on historical data, and the historical data had one enormous hole in it. There had been no nationwide decline in American house prices since the Great Depression. Regional falls, yes, everywhere at once, no. So the models did not really contemplate it. The correlation between defaults in different states was assumed to be low because it always had been. That single assumption is the one that breaks. When house prices fell everywhere simultaneously, the diversification that justified the AAA ratings simply evaporated. The 1,000 mortgages in the pool stopped behaving like 1,000 independent bets and started behaving like one very large bet on a single thing: American house prices. And that bet was already going wrong. Nationally, house prices peaked around the middle of 2006 and began to slide. Borrowers who had counted on refinancing before their rate reset found there was no equity to refinance against. Defaults climbed through 2007. By the summer of that year, the market in these securities was seizing. Two Bear Stearns hedge funds invested in subprime paper collapsed in June. In August, a large French bank suspended withdrawals from 3 funds, saying it could no longer value the assets inside them. Which was a remarkable admission, not that the assets were worth little, that nobody could say what they were worth at all. That is the moment the crisis really begins, and it is not a moment of panic. It is a moment of silence. The bids simply stopped. And that silence had a consequence that made everything afterwards worse, because of an accounting rule. Banks were required to value many of these holdings at market prices, mark to market. In normal conditions, that is a sensible discipline. It stops institutions carrying assets at whatever figure flatters them. But it assumes a market exists. When the bids stop, there is no market price. And the price that gets used instead is whatever the last desperate seller accepted, which may be far below what the underlying mortgages would actually have paid over time. So a firm that intended to hold its securities to maturity, and might well have been repaid in full, had to write them down to a price achieved in a fire sale it was not even part of. Those write-downs hit capital. Reduced capital meant lenders demanded more collateral, which forced more selling at prices that then became the new marks for everybody else. There has been argument ever since about how much this amplified the crisis, and it is a genuine argument rather than a settled one. But the direction is not disputed. In a market with no buyers, the rule designed to force honesty also forced a spiral. Now, the part of the story that is usually skipped, and without which the following September makes no sense. How does a large investment bank actually fund itself? Not primarily with deposits. These were not high street banks with millions of savers. They funded themselves in the short-term wholesale markets. Overnight repurchase agreements, commercial paper, and similar instruments. Borrowing enormous sums for very short periods, secured against the securities they held, and rolling that borrowing over continuously. Think about what that means operationally. A firm holding hundreds of billions in long-term assets might be refinancing a very large portion of its funding every single day. That works beautifully while lenders are relaxed. It is extraordinarily efficient. And it means the firm is never more than about 24 hours from needing the market's confidence again. This is the crucial thing to understand about 2008. These institutions did not fail because someone tallied up their assets and found them insufficient. They failed because the overnight funding stopped arriving, and no institution on earth can survive that, solvent or not. It is a bank run. It simply does not look like one because there is no queue outside a branch. The run happens between institutions, by wire in the morning, and it is invisible until it is over. And there is a mechanism inside it that makes the collapse faster than anyone modeled, called the haircut. When a firm borrows overnight against securities, the lender does not advance the full value of the collateral. It lends slightly less, and the gap is the haircut, the lender's protection if the collateral falls in value before it can be sold. In calm conditions on high-quality collateral, that haircut might be close to nothing, a fraction of 1%. Now watch what happens when lenders become nervous. They do not refuse to lend. That would be a dramatic, visible decision. They simply raise the haircut. And on some categories of mortgage-backed collateral, haircuts went from near zero to figures in the tens of percent over the course of the crisis. 25%, 40%. In some cases, the lender simply declined to accept that collateral at all at any price. Follow the arithmetic. A firm funding $100 billion of securities now has to find tens of billions in cash it does not have. It has one option: sell securities. But every comparable firm is doing exactly the same thing on the same morning, into a market with no buyers. So prices fall, and falling prices mean the collateral is worth less, so lenders raise haircuts again, so more must be sold. That is the spiral. Nobody has to panic, and nobody has to be wrong about the fundamentals. Each individual lender is behaving with complete prudence. The prudence is the problem. It is the sum of it that destroys the market. Bear Stearns went first in March. Over roughly a week, its lenders stopped rolling over its funding and demanded more collateral. It went from apparently viable to gone in days. The Federal Reserve arranged its sale to J.P. Morgan Chase at a price that began at $2 a share and was later raised to $10. For a firm whose shares had traded around 170 the previous year. And here the story takes a turn that matters enormously for what happens in September. Bear Stearns was rescued. Its creditors were made whole. The lesson the market drew was reasonable. The authorities would not allow a major institution to fail outright. That belief kept funding flowing to firms that might otherwise have been cut off months earlier. And it made what happened later far more violent, because it had never been priced in. Through the summer, the pressure moved to Fannie Mae and Freddie Mac, the two enormous government-sponsored enterprises that stood behind a very large share of American mortgages. On the 7th of September, they were placed into government conservatorship. That was already an extraordinary intervention. Trillions of dollars of mortgage exposure taken onto the public balance sheet. And it bought about 1 week. Now the week itself. The following weekend, Lehman Brothers, the fourth largest investment bank in America, 158 years old, founded before the Civil War, could not fund itself. Regulators, executives, and rival bank chiefs spent the weekend at the Federal Reserve Bank of New York trying to arrange a buyer. Two candidates emerged and both fell away. Barclays could not proceed without a shareholder vote that could not be held in time. Bank of America went instead for Merrill Lynch, which was itself in serious trouble, and sold that same weekend rather than face the following one alone. There was no rescue. The public position was that there was no legal authority to lend against insufficient collateral. There has been argument about that ever since, and this video is not going to pretend it is settled. On Monday, the 15th of September, Lehman Brothers filed for bankruptcy. Around $600 billion in assets, the largest bankruptcy filing in the history of the United States by an enormous margin. And here is where it stops being a story about banks and becomes a story about everyone. Because of who owned Lehman's short-term debt. Return to the Reserve Primary Fund. A money market fund founded by the man who essentially invented the product in the early 1970s. $62 billion under management. Money market funds work by holding very short-term, very safe debt, treasury bills, and commercial paper, which is simply the short-term IOUs that large corporations issue to fund day-to-day operations. The fund holds a portfolio of these and maintains a share price of exactly $1. That $1 share price is the entire product. Companies use these funds as their cash accounts. Payroll sits there. It is not marketed as an investment with a small chance of loss. It is treated as money. The Reserve Primary Fund held around $785 million of Lehman Brothers commercial paper. On Monday, Lehman filed. That paper was suddenly worth a fraction of its face value and quite possibly nothing. On Tuesday the 16th, the fund announced that its shares were worth 97 cents. The phrase for this, in an industry that had barely needed one, is breaking the buck. Now watch what happens next, because this is the actual mechanism of the crisis. Every corporate treasurer in America now had to consider a question that had never seriously arisen before. My cash is in a money market fund. Does that fund hold paper from any institution that might fail this week? For most, the honest answer was, I do not know and I cannot find out by Friday. And when you cannot assess the risk, and the downside is being unable to make payroll, there is only one rational move. Withdraw the money and put it in treasury bills. So they did. Hundreds of billions of dollars flowed out of prime money market funds in a matter of days. And here is the second-order effect that turns a fund problem into an economy problem. Money market funds were among the largest buyers of commercial paper. Facing enormous redemptions, they had to raise cash immediately, which meant they stopped buying commercial paper and let their existing holdings run off. Commercial paper is how a very large number of American companies fund their ordinary operations. Not speculation, wages, inventory, suppliers. The market for it was measured in the trillions, and it did not shrink gradually. For paper of longer maturities, it very nearly stopped. This is the moment referred to in the title, not a share price. A market in which perfectly healthy companies, with no exposure to mortgages of any kind, discovered that the routine borrowing they did every month to pay their staff was no longer available at any price. Meanwhile, on that same Tuesday, the insurer AIG was hours from collapse. Its financial products division in London had written enormous quantities of credit default swaps, in effect, insurance on exactly the securities now failing. As the securities were downgraded, AIG faced collateral calls it could not meet. The Federal Reserve extended an $85 billion credit line, taking a controlling stake in one of the largest insurers in the world. That figure eventually grew to well over $180 billion. So Monday, the largest bankruptcy in American history. Tuesday, the effective nationalization of the world's largest insurer, and a money market fund breaking the buck. Wednesday and Thursday, a run on the funding market that underpins ordinary corporate operations. Yields on short-term treasury bills fell to essentially zero, and at moments traded at a negative yield. Read what that means plainly. Investors were prepared to accept a guaranteed small loss for the certainty of getting their money back. There was no interest in return. There was only interest in return of. And it was not confined to the wholesale markets, because the following week brought the ordinary kind of bank run as well. Washington Mutual was the largest savings and loan institution in the United States, with something over $300 billion in assets and a very large book of exactly the kind of mortgages now failing. Over roughly 10 days, its depositors withdrew around $16 billion. On the 25th of September, regulators seized it and sold its banking operations to J.P. Morgan Chase. It remains the largest bank failure in American history. Its depositors, it should be said plainly, lost nothing. The deposit insurance system did precisely what it was built to do and did it without drama. Days later, Wachovia, another very large retail bank, had to be sold in an emergency, eventually to Wells Fargo after a competing arrangement fell apart. So within a fortnight, the largest bankruptcy in American history, the largest bank failure in American history, the rescue of the world's largest insurer, and the freezing of the market that funds ordinary corporate payroll. There is one more dimension, and it is the one most often left out of American accounts of the crisis, because the shortage was not only American. European banks had been enormous buyers of American mortgage securities, and they had funded those dollar assets with short-term dollar borrowing, because that is what you do when the asset is denominated in dollars. Which meant that when dollar funding markets froze, a large number of institutions outside the United States suddenly needed dollars they could not obtain at any price. They could not simply print them. Their own central banks could not create dollars either. There was exactly one institution on Earth that could. So the Federal Reserve extended currency swap lines to other central banks, to the European Central Bank, the Bank of England, the Bank of Japan, the Swiss National Bank, and later to a wider group including several emerging economies. In effect, it lent dollars to foreign central banks, which lent them on to their own banks. At their peak, the amounts outstanding under those arrangements ran into the hundreds of billions of dollars. That is a quietly enormous fact. In the autumn of 2008, the Federal Reserve was not merely acting as the central bank of the United States. It was functioning as the lender of last resort for the entire dollar-denominated financial system, wherever in the world it happened to sit. On the 19th, the Treasury announced a temporary guarantee for money market funds, using the Exchange Stabilization Fund, a pot of money created in the 1930s for an entirely different purpose. The Federal Reserve began standing behind the commercial paper market directly, eventually buying the paper itself when nobody else would. That is what it took to restart the plumbing. The government guaranteeing the thing everyone had always assumed did not need guaranteeing. Then came the legislative fight, and it is worth telling honestly because it did not go smoothly. The Treasury proposed a $700 billion program to buy troubled assets from banks. On the 29th of September, the House of Representatives rejected it. The Dow Jones fell more than 770 points that day. At the time, the largest single-day points decline in its history. Congress passed a revised version days later. And here is a detail worth sitting with, because it shows how much the understanding of the problem changed inside a fortnight. The program was designed to buy troubled assets. It was largely used instead to inject capital directly into banks, including into banks that insisted they did not need it, so that accepting the money would not itself be read as an admission of weakness. That change of approach is the clearest evidence of what the authorities had worked out by October. The problem was no longer the assets. The problem was that no institution trusted any other institution's balance sheet. And the only way to break that was to make every major bank visibly, publicly backstopped at the same time. So what did it cost and who paid? The financial figures are large, but they are not the real number. Household net worth in the United States fell by an amount usually estimated in the tens of trillions of dollars. Unemployment climbed to 10% by late 2009. Around 9 million jobs were lost. Millions of homes were repossessed. Recovery in employment took years. In household wealth for many families, considerably longer, and for some, not at all. Because a home repossessed at the bottom is not recovered when prices rise again, somebody else owns it. And the distribution of the pain is the part that has shaped American politics ever since. The institutions at the center of the machine were, in the main, stabilized. Many of the people at the outer edge of it were not. Very few senior executives at major American financial institutions faced criminal prosecution over the conduct that produced the crisis. That is a factual statement about outcomes, not a claim about who deserved what. But it is the fact that most people remember, and it is the reason the word bailout still carries the charge it does nearly 2 decades later. Let us end where the mechanism actually lived, because it is the part most likely to matter again. The lesson people usually draw from 2008 is about greed, or about housing, or about complexity. Those are all real, and none of them is quite the mechanism. The mechanism was this. An enormous quantity of long-term, hard-to-value assets was funded by borrowing that had to be renewed constantly, daily, in many cases, from lenders who had no ability to assess those assets and every reason to run at the first sign of doubt. That structure works perfectly while confidence holds, and it is highly profitable, which is precisely why it grew so large. And it fails almost instantly when confidence goes, because there is no time for anything else to happen. A firm that needs the market's approval every morning is never more than one bad morning from the end. None of that requires a housing bubble. Housing was the thing being financed in 2008. The fragility was in how it was financed. And the deepest point is the reserve primary fund, demonstrated in a single day. The system depended on a set of things that everyone treated as certainties, and that were not written down anywhere as guarantees. $1 in a money market fund comes back as $1. Commercial paper always rolls over. AAA means safe. None of those were laws, they were habits. Habits so reliable that everybody had stopped noticing they were assumptions at all. And the crisis, when it came, was not really about mortgages. It was the several days in which the American financial system discovered which of its certainties were actually promises, and which were only habits. There is a postscript, and it is the reason this matters beyond history. A great deal was rebuilt afterwards. Banks were required to hold substantially more capital and to pass regular stress tests. New rules restricted some of the activity at the center of the crisis. And money market funds were reformed. Institutional funds of the kind that broke in 2008 were eventually required to let their share price float rather than pretend it was fixed at $1. Then, in March 2020, with a pandemic arriving and no mortgage securities involved at all, investors again pulled very large sums out of prime money market funds. The commercial paper market again came under severe strain. Even the Treasury market, the deepest and most liquid market in the world, became disorderly as everybody tried to sell at once to raise cash. And the Federal Reserve responded by launching facilities to support money market funds and to buy commercial paper directly. They were, in substance, the same facilities built in 2008. Some of them carried almost the same names. Draw the right conclusion from that, because it is not that the reforms failed. The system in 2020 absorbed an extraordinary shock without a single major bank failing, which is exactly what the capital rules were built to achieve. The conclusion is narrower and more uncomfortable. The specific fragility at the heart of this story long-term assets funded by money that can leave in the morning, sitting in institutions people treat as cash, was reduced. It was not removed. It is a structural feature of how modern finance funds itself, and when it comes under enough pressure, the resolution is still the same one found in September 2008. Somebody with the ability to create dollars has to stand behind the market until everybody calms down. That is the machine. It is remarkably efficient. It is genuinely useful, and roughly once a decade it has to be rescued. Sources and method. This account draws on the Financial Crisis Inquiry Commission's report to the United States Congress, the published accounts and testimony of the Federal Reserve, and the Treasury from that period, Securities and Exchange Commission filings, including Lehman Brothers bankruptcy petition, and contemporaneous reporting from September and October 2008, where figures are estimates, total household wealth destroyed, the ultimate cost of the AIG intervention. This video says so rather than presenting a single number as settled. Where there is genuine ongoing disagreement, most notably over whether the authorities had the legal power to rescue Lehman Brothers and chose not to. It sets out that the argument exists rather than resolving it.